What's up, everybody? Simon here. The housing collapse has started with the demand for homes falling by 22%. Before I get into this video, I always ask that you guys like the video, subscribe to the channel. I truly appreciate it. It's the biggest favor you could do for me, and it's free. Let's get into this collapse. So the real estate market was booming. We've had Florida doubling in property. We have Texas doubling. Colorado, places in Colorado, Nevada was through the roof. I mean, Las Vegas, I've seen homes with about 500 properties on the real estate market at one point. Now there's over 3,500 properties for sale in Las Vegas at any given minute. So overall, we're seeing more surplus of inventory and the prices are coming down with less offers. No one is overbidding anymore. So the collapse is here. Crazy inflation has also been met with recession and rising interest rates, which is leading the housing collapse. Mortgage demand fell last week to the lowest points since 2000. That's in the last 22 years. Mortgage demand is at its lowest point. That's incredible. That is crazy. And it's all because buyers have lost considerable purchasing power. If the interest rate has gone up by double, they're no longer able to afford a house, even entry-level homes, but certainly not even premium homes, which they could have made a purchase as a stretch in the past. And what's happening is the higher the interest rate continues to rise, the less demand we see with the mortgage collapse or the housing collapse. So we're going to see even more houses out on the market as foreclosures continue to put more properties on the market and as buyers are out of the category of actually being able to afford a home with such high interest rates. Mortgage fell 6% last week compared to the week before. And again, as I mentioned, it's at the lowest level since the 2000. Now, we're not even talking about the 2008 crash, which completely wiped out the real estate game. I've known so many people that lost a lot of money in the 2008 real estate crash and almost went bankrupt. The 2000 collapse was also a recession. However, it wasn't as bad in real estate as the 2008. So that really says something where we are with mortgage interest. And applications for mortgages in the last week dropped by 7% and are nearly 20% lower than the same time period last year. It's all about purchasing power. So if there is no purchasing power, then there will be a lack of sales. However, I'm starting to see it even here in the Bay Area where houses are staying on the market a lot longer. You're getting a lot less bids. I'm seeing price cuts on Redfin, on Zillow, and pretty much every website out there that's listing the MLS listings. So overall, people are no longer able to offload their houses. In vacation homes, for example, I am seeing homes staying on the market for such a long period of time where the prices are getting slashed to pre-pandemic levels as well as pre-boom levels in the real estate market. So vacation homes are taking a big hit. And if you're interested in vacation homes, you should check out my Should You Buy a Vacation Home video where I talk about whether or not it's worth buying a vacation home. Certainly in this time, no one is buying vacation homes, and primary residents or new build-outs are also seeing a hit. The good news, however, is that the rising interest rates have already taken its toll. We're not sure how much higher the interest rates could go. I did make a video that can the interest rate go back up to 10%, which it was before in the past. It's possible, but I don't think that scenario might be happening this time around. So hopefully the interest rates are peaking out and people are going to start adjusting, realizing this is where the market is today. And the market hopefully or the interest rate will go down to favor the market in the near future or maybe within a year, etc. However, during this time, the market is greatly affected by the doubled interest rate, and it has taken a lot of people out from affordability of a home. Another crazy factor is when the interest rates were at 2.5 to 3.5%, demand for refinancing was through the roof. I have some friends that are brokers that do mortgage loans, etc., and their refinancing was so high during that period that now at this period, it is no longer a business. It's no longer a demand for them because the refinance rates are typically higher than a 30-year mortgage rate. So all of the sudden, the demand for refinances has fallen about 4%. And guess what? They're 80% lower than the same time last year. That just shows you how many people were refinancing their homes, how much money was being made by these brokers while the rate was low. And now refinancing is not even an option pretty much for anyone out there. With mortgage applications and refinance applications dropping completely, we are seeing a stagnant real estate market that possibly will only get worse. The only areas where the real estate market will continue to thrive is in demand areas with a lack or scarce availability for new structures. So for example, maybe some of the richest neighborhoods, although prices are going to fall there still will be demand because of good school districts, neighbors, etc. Now, there is some slighter or better news as well. Although the mortgage rates are continuing to rise, 40% of the homes have actually sold at asking price, which means that overall there might be slight cuts. There's definitely maybe some offers that go over, but we're definitely experiencing a slowdown in the market. Yet, the market average rate is still 14 days. For a sale, which is historically low. So overall, it's showing signs of some type of stability and homes are still selling, maybe not selling much over than they used to before. Now, is the drop everywhere? No, it's not. There has been drops in certain markets like San Jose, San Francisco, Austin, Texas, and a few other areas that have seen increases. San Jose led the drop by 4%. However, other areas like Miami and Florida has boomed. They've actually seen increases and an increase in demand in their market. And it's because many people are still trying to move out of California or states like California, such as New York, to save on income tax, to change their lifestyle, potentially change their political views or the people that surround them. You could check out my California Exodus video where I talk about why people are leaving, how many are leaving, and what's happening to California. So even though there is a crazy drop in the real estate market and it has started, overall, everyone, including Zillow, is still estimating a price increase of properties year over year. They're no longer above 5% like they estimated before, but Zillow, for example, is estimating 2.4% of an increase in terms of price year over year or next year. So if you do buy a property, Zillow's estimating it's going to go up. Now, Zillow's not the best at estimating. If you do your research, Zillow has lost a ton of money overestimating their properties, buying them up at the estimate offers and losing while trying to sell those properties. So I don't know if that's a reliable source, but overall, a lot of other agencies are also estimating that real estate will go back up or will increase year over year, regardless of the demand. So the market that was once booming just a year ago with the lowest interest rates in history, all of a sudden is now back down to reality. And it's not back down to the point where we're in jeopardy, but overall it's settling, it's cooling. I think buyers are having more opportunities to pick different homes. The interest rate is killing any real estate developer seller. And overall, now there is going to be more properties on the market based on foreclosures, based on less demand, and based on more people that are finally finishing up the booming real estate market in terms of remodels from a year ago, now pushing out their houses to the market just a bit too late. San Francisco is an interesting area because a lot of people were moving out during the pandemic because it was a shutdown city. Now it's opened up, so it kind of slightly rebounded with people now gaining interest again in living in the city, with companies like Google and Apple requiring people to go back into the workforce and others following. maybe that city will revive itself. However, overall, it's still a down market. And I think the only markets that are going to continue to thrive are places that are completely open, such as Florida, Texas, etc., and Florida leading the way just tremendously in real estate like we've never seen before. So I hope you enjoyed this video. Comment below if you have anything to add. Remember to like it. It's free. Subscribe. That's free too. And I appreciate it. It's the biggest favor you could do for me. I read your comments. I hope the market rebounds. I don't think you should invest in real estate at this given moment. It may be wiser to be cash rich or cash heavy when the market bottoms out. Then you make your investment, you make money on the buy always, and then you'll have a better opportunity. If you do buy a property today, make sure you're thinking long-term versus short-term, say 5 years from now. Anyway, I hope you enjoyed this video. Thanks again. Catch you here in the next one.